So I was born in Murmansk, Russia. If you look at the map of Russia and you look to the left and you go to the very, very, very top, like above the Arctic Circle. So like it's kind of on the northern side of Norway. Like that's how, so it's incredibly cold. It's there's basically, if you think about throughout the year for a few months during the winter time, there is no sunlight, very little sunlight. Like imagine this: I go to school in the morning and it's dark. Sometime during the day, the sun would come out for 20 minutes. I would be in the classroom, and when I'm going back, then so I miss the sunlight, and I'm going back in the darkness again. And this was my kind of my life during basically throughout winter. It's kind of interesting. So growing up in Russia, and not just Russia, but Soviet Russia, I learned to appreciate capitalism. Okay. I did not know it at the time. And here's my analogy. So when I moved from Murmansk, I moved to Denver. And Denver has 320 or 30 or 50 days of sunshine a year. Okay. So imagine the contrast going from this no sunlight to sunlight to a lot of sunlight. So the contrast between the two is huge. So is kind of capitalism, because when you grow up in a society where the government owns all basically means of production. I'll give an example. I did not know a single person who owned their own business. Every single person around you worked for the government. Even the barbershop, it was government owned. And so when you go get a haircut, you get a horrible service. You know why? Because nobody cares. Because they don't own it, right? And you move to the United States and you see this contrast between what this country has to offer versus where you came from. And I think that is incredibly motivating. Like, so being an immigrant, I would argue, actually is a huge advantage, because you can see what this country has to offer where you came from. And this contrast, it's kind of lights the fuel under you. And that's what basically motivated me to achieve what I have achieved in this country.
And when you came over to Denver, do you feel like, I know we've talked to a certain amount of people who have immigrated to the U.S. and under different circumstances. Some people come with a more of like a scarcity mindset. Did you find yourself like that was kind of the situation when your family moved over? I know, like myself, like I grew up like fairly poor, even though I'm from the U.S. But so like I definitely have a part of that in my financial journey. Just kind of curious what that was like when you moved over.
It's very interesting. It was this cultural shock. You go to the store and there was this abundance of food. Okay. And I remember, this is a true story. Like in Russia, I think I had Coca-Cola, Pepsi. I think I had Pepsi once throughout my 18 years of, and I remember how much I loved it. It was such a special feeling. And I come to the United States and you can buy Coke or Pepsi by gallons. And I tell you this is true, absolutely true. In the first 2 years of my life in the United States, I made up for the lack of my consumption of Coke and Pepsi for the previous 18. It got to the point. So this is very important. It got to the point where I was 20, 21 years old. I'm at the Village Inn. Am I ordering my third refill of Coke? And I realized I can't taste the sweetness anymore, because now it tastes like water. And then and this is where I told myself, you know what? I consume all this sugar. I'm not even enjoying it. So I basically said, I'm going to drink it just on special occasions, like when I go to movies. And since then, this is almost 30 years ago, 20 something years ago, I've been basically drinking Coke a few times a year. And I tell you this, there is some value in scarcity, because every time I drink Coke today, I enjoy it so much more. So there is actually scarcity. There is so many benefits of scarcity, which we usually don't appreciate. First of all, it makes us to enjoy things more. From a business perspective, when something is scarce, it makes you work harder to figure out. This is almost switching topics a little bit, but I read about Segway. The Segway company and this company, kind of it has been a flop from a commercial perspective. In the sense, you still see segues, but it's not like everybody around you has a segue, right? And I read the business case why it hasn't succeeded. Because the company, when it came out, the technology looked so revolutionary. It got so much money thrown at that they didn't really, the company did not really have this drive to figure out this product market fit, how to make this product that actually consumers want. And a lot of people get turned off by Segway because when you write a Segway, you look lazy. It's for psychological reasons. You look like you are kind of standing there and it does it for you. And that's one of the reasons why the product never succeeded. If they were hungry, if they had to figure out how do we make this product that actually the consumers really like to fit what psychological mindset of consumers, it probably would. Yeah, if they had less money, it would have been a lot more successful. Anyway, I'm kind of switched gears a little bit, but yeah.
So to kind of get back to your story, when you move over here, you move to Denver, you're 18 years old. I just want to kind of get back to building out like how today's Vitaliy was formed. What did your kind of life trajectory look like? Or at least what did you conceptualize? Like, what do you think life was going to look like after, the first few years in the US? Like, did you already have a game plan mapped out as an 18-year-old? Like, I'm going to do this, and this?
Oh, God, not at all. I was just happy to get out of Russia. I just got here, and I had no idea what I wanted to do. I knew that I was a complete cultural shock. I went to college in Russia, come to the United States and realized if I go to college, I would have to pay out of state tuition, which costs 2 or 3 times more. So I actually went to high school to study English, and I ended up graduating from high school here. And it took me maybe, I dated like 6 or 7 different majors in college before I figured out I wanted to finance. And once I realized I wanted to do finance and investing, it was love at first sight. And when something is so clear to you, that's what you want to do. For me, it created this incredible focus because at this point I said, that's what I'm going to do. I knew exactly what I wanted to do. I need to get an undergraduate degree in finance, graduate degree in finance, CFA, and I got all 3. And in fact, I got my graduate degree in CFA at the same time. So I don't think I had this clarity until I was in this country for a few years. The first couple of years, I was just confused about the culture and the language and etc. And I was confused that people, like in Russia, people don't smile. Like I'm speaking of Russia 30 years ago, people did not smile at you. Like people smiled at you because when you made them laugh. You never walked in the street and somebody smiled at you. Like smile actually carried data, like in a sense, like somebody smiled at you, it communicated something. Here, I remember like I was getting fired from the first job and the guy was smiling at me. So I couldn't really reconcile how could I be fired by a guy who is smiling at me. Like you take those things for granted, but that was a cultural shock for me.
And when you decided, I know you said it was like love at first sight when you decided, hey, finance is the way I want to go. But did you have any kind of exposure to finance or like the industry around it? Or like, how did you even end up considering finance as an option?
Yeah, so in Russia, I had zero exposure to that. Here was actually, I got a job. I self-taught myself computers, and which at the time was not that difficult because all I had to do is kind of learn how to install DOS operating system, Windows, this kind of stuff. And I got it. So I got a job at the investment firm for my computer skills, to help them to manage all the computers and stuff, install software, etc. And while I was there, they had a Bloomberg terminal, and I was playing with Bloomberg. There had a lot of people, like analysts, portfolio managers, ended up talking to me, and I realized that piqued my interest. And then at university, I was taking different classes, and I remember taking a business class because I was thinking I'm going to become a manager. And I took a business management class, and I realized how much I hate this. And I remember coming up to my teacher and saying, thank you so much. Now I know I don't want to become a manager. And the guy was shocked because he thought I was insulting him, and I was thanking him because he did a very good job explaining what the profession looks like. And I realized I don't want to do this. And then I took finance class, and it just was interesting to me. I remember I came home and I was talking to my father for 20 minutes what I learned in class. No other class evoked that kind of, had this kind of reaction, evoked this kind of reaction from me.
So let's kind of fast forward through the next couple decades, I guess. So you started this firm, was it 97, I believe I read?
I joined the firm. I didn't start it. The firm was already around. I joined as an analyst originally, yes.
Okay, so you joined as an analyst, and then I think it was like 15 years later, or you can correct me if I'm wrong, you were CEO at that point. What did those... That's quite a jump in 15 years.
No, so I joined the firm as an analyst, and at the time, the firm is very small, and I basically learned how my partner, a gentleman who later became my partner, Mike. He basically taught me everything I know today about investing, and over time I became became portfolio manager, became chief investment officer. I wrote a couple investment books. And as Mike kind of was transitioning towards retirement, I took over the CEO. And I'll tell you this, Warren Buffett says that being a businessman made him a better investor, and being an investor made him a better businessman. I would argue the same thing. I became, learning how to manage a company. It's a skill that they don't really teach you in the graduate school, and that was so beneficial to me because it taught me one of the most important lessons is the value of people. You don't it sounds very banal, sounds very trite, but my firm is really it's a culture plus people. It's a culture of processes and people. That's all it is. And the value of people, today when I analyze companies, in fact, when invest into companies, I spend as much time thinking about people who run those companies as the company's competitive advantage, return on capital, valuation, and other things. Since I became a CEO, we basically, the company, the size of the company went up like 8-fold.
And so when you're saying like you're looking at companies trying to figure out if it's a company like you believe in, you're saying you not only do you look at earnings reports and all the projections and the numbers behind it, but you're actually going out there and looking at who's on their board, who their CEO is, like who are the people at the helm, and researching if you believe in them.
Oh, absolutely. And we listen to, we spend a lot of time listening to interviews with that CEO. We listen to what they have to say on earnings calls and how they talk about the company. Are they talking about next 3 months, or they're talking about next 3 years? Okay, people who are only talking about next 3 months and how they're going to beat earnings next 3 months, those people we have very little interest in them, because we want people to build moats around the business, not just meet and beat next year's earnings. And I would argue that Jack Welch went in the history books as this tremendous CEO, kind of champion of corporate America. And I would argue he did more harm than good for corporate America, because he instilled the culture that the company has to beat next quarter's earnings, and which basically makes your focus very short term. If you think about Jeff Bezos versus Jack Welch, Jeff Bezos doesn't care about next quarter's earnings. He's building. In fact, he's willing to because a lot of times to build a good company, you need to make investments. When you make investments, that you create an extra expense, which actually reduces your earnings next quarter. Okay. But by doing this, you're coming up with Alexa, and you're coming up with other products that's going to pay off years down the road. And when you see what happened to General Electric over the last 20 years, that's basically the company where R&D and the culture was squeezed, for the benefit of quarterly earnings, and the company collapsed.
And I know you talk a lot about value investing. I mean, your last two books previous to the one we're going to talk about today, Soul in the Game, one was almost exclusively about value investing. The other one was about, making money in sideways markets. Can we just talk about value investing and kind of just how you think of it, like at a 30-foot level, like just the value investing framework when you're looking at companies?
Sure. So value investing in general, the whole term is redundant. It should be just investing. It's an incredibly commonsensical framework. When I analyze companies, I'm basically looking at the company as if it was a private company, even though we invest in public companies. But if I'm analyzing Apple or Amazon or whatever, I'm analyzing it as if I was buying the whole company and as if I was going to own it for a long, long time. It's as if stock market was closed for 10 years. Once you get into this mindset, suddenly you start looking at the company, suddenly the ability to flip the stock tomorrow and looking at and treat the stock market as a kind of as a casino, that goes away, and you kind of get in the shoes of an investor. And I have this. If your listeners want to learn about this, it's absolutely free. I have this chapter I put online. If they go to sixcommandments.com, I kind of wrote out the primer for value investing. I call it the 6 commandments of value investing, and all it is basically. Let me highlight a few. So commandment number 1, you treat companies as businesses, as I just described, not as a piece of paper. Okay, so number 2, you have a long-term time horizon. Let me tell you a secret that nobody knows what the stock market will do or stocks will do in the next 3 to 6 months. Nobody does. You listen to CNBC and you have all these talking heads giving you advice and giving you an opinion on the market. They don't know. Nobody does. It's just like you don't know what card is going to come next at the blackjack table. You really don't. The third, another commandment is that Mr. Market is there to serve you, not the other way around. In other words, the market will have ups and downs. And if you know what the company is worth, and you know this because you've done the research, then when the company becomes too expensive, you sell it. If it becomes overvalued, and it becomes cheap, you buy it, right? And that's the mindset that the volatility, kind of the fluctuation of the stock prices, they're really just there to help you to make money. And and so on. There's there are other ones, but value investing is basically a philosophy. It's a kind of a framework of how to be a rational investor.
And I think a lot of times, I'm sure a lot of listeners would feel this way when you hear the term value investing. A lot of times you think about these like tried and true companies that have been around for a long time, like a Coca-Cola or something. Mm-hmm. But if that's where your mind goes, like what do you do in those situations where you're thinking about a newer company, a company that doesn't have as much of a track record because they haven't been publicly traded for that long? Like, how do you look to continue to add new things to your portfolio and not just building on a certain subset of companies that have been around for a long time?
So let's see. So far, I discussed long-term time horizon, treating the company as a business, Mr. Markets, how to help you. The fourth one is going to be margin of safety. When you buy a company, and I'm going to answer your question, but this is how I'm going to answer it. So when you buy a company, you want to buy it at significant discount to what it's worth, because the future may not turn out as bright as you hope it would be, and therefore you need the margin of safety for this. Now, when you're looking at the company that doesn't have a track record, right? Then the range of outcomes, again, I'm generalizing right now, is very wide, right? So how would the value investor apply this framework? You basically want to buy a company at or below the worst outcome, right? By the way, one of the companies we own in the portfolio, and I'm bringing this up not to pitch the stock, and this is not what I'm doing. I just want to make it clear. We own Uber. You would argue Uber is not your traditional Coca-Cola or IBM, but so in my thinking about Uber, this is a company that has competitive advantage. This is a company that will be around in 10 to 20 years. And this is a company that may not have much profitability today, but through my research, we think it's going to have a lot of profitability in the next 3 to 5 years. And based on that profitability, that's not apparent today, but we believe this company is cheap, again, through our research. And if your listeners are interested, they can read my analysis on that. But that's not the point. The point is, value investment is a philosophy. It doesn't like, so Justin, you make a very good point, because a lot of times people think about value investing and they think about just buy companies that look statistically cheap, right? I think it's like going to a museum and just paying attention to, it's like reading, like it's a completely ignoring, like I was going to use the analogy because the kind of the Bible of value investing is Ben Graham's Intelligent Investor. And that's what a lot of times people read this book and that's all they get out of it. Buy companies that trade at 8 times earnings. Okay. But my point is, like, if that's all they get out, they miss the philosophy. And the philosophy, what I just described, right? It's like going to a museum, going to Louvre, and basically not skipping Mona Lisa and just going to the bathroom and, and getting and learning that it has soft toilet paper, this kind of thing. So that's what the people, if that's all people get out of reading The Intelligent Investor, because it's a very rich philosophy.
And shifting focus to personal finance a bit, I know you had a chapter and we were talking quickly about it before we hit record here in your latest book, Soul in the Game. And it seems like, I think you said something like it was the best wedding gift you got was lunch with your friend Mark. So could you expand a bit on that for our audience?
Yeah. So I got married when I was 28. And just, I have to explain this. At that time, until that point in time, I lived with my parents. Which is kind of very kind of Russian thing to do. Like, you live with your parents, you get married, you move out of the house. Even though at that time I already had a job, et cetera, and so, but I knew nothing about personal finances. I did not even know how much things cost at the grocery store. And it's a funny story. I went to, right maybe 6 months before I got married, I went to London and I brought my stepmom, British tea. And I was so proud of it because I brought her the British tea. And this tells you about how little I knew about grocery stores, because she said, yeah, that's the same tea I buy every time I go to a grocery store. Because anyway, so I know nothing about personal finance. I know nothing about what things cost. And my friend Mark, who was 10 years older, he basically sets me down with my wife and says, guys, let me give advice that can help you a lot when you get married. And he said, you have to do a budget. Okay, in the budget, you list your revenue, kind of your income, your expenses. And at this point, I kind of was getting annoyed because at this point, I have a master's degree in finance and I have a CFA. Okay, and now the guy's, my friend is explaining about income statement. I'm like, okay. But he said, listen, when you think about expenses, don't just think about expenses like, that appear to you like right away, which would be like cable bill, mortgage, groceries. You also have to think about expenses that will happen to you in the future. Okay. Because you have to do this time shifting, because they're going to be expenses that are going to happen to you in the future that you have to put on the budget. Like every so many years, you're going to buy a new car. So, and if let's say it's going to cost you, it's going to cost you $5,000 every so many years, that means it's going to cost you $100, a few $100 a month. So that's an expense that's going to happen in the future that you have to save for. You're going to have, you have a $1,000 deductible on your car insurance. That is a potential future expense. So that's money that you want to put away as well. And, so you start going through and then identifying expenses, kind of doing some time shifting expenses that, like even your retirement, that is a future expense. You don't want to just, when you are 60 something years old, realize, oh, I should have saved for the retirement. You should start saving for your retirement when you're young. It's much easier to do that. And so what Mark basically said, when you create your income, budget, you have your revenue, your income, your expenses, that you can see right now, and then your what he would call sinking funds, and those and what's left, that's the money that you can spend on things that are less important. But here's the thing: what budget is, it forces you to mindfully think about your expenses, because if you like in life, you do a lot of things mindlessly, like like one day you've been driving to work, and you stop by Starbucks. And then the next thing you do the same thing. And then it became a habit. Okay. So if you really enjoy going to Starbucks and you receive you receive a lot of joy from going to Starbucks, it should be ranked higher on your budget list. So, but if you just mindlessly been going to Starbucks because you've been going to Starbucks and you realize it's close to $1,500 a year, maybe that should be in the very low end, very low on your budget. On your budget, okay. So what budget does allows you to rank things, to mindfully examine your expenses, and then you can prioritize things that are more important to you and less important to you. And then guess what? If you find for my family, going to Starbucks is less important than going on vacations, because we find the experiences have bring a lot more happiness. Okay, therefore they're much higher on that list. And I don't do this anymore, but for 15 years of our marriage, we actually saved money for vacations. So that was one of those sinking funds. So when we went on vacations, we didn't have to get in debt and put it on a credit card, because that's the money that was saved for us. And that was a point Mark was trying to drive across, is that the issue is what happens to us a lot when those expenses that kind of happen on a semi-regular basis, but we miss, come up, we have to get in debt. And when we get in debt, we start paying interest, and interest and compounded interest becomes very, very expensive, very, very fast. So that's what those kind of the lessons I learned from that conversation.
And that makes it sound like, at least from your story, that up until that point, you're understanding an idea of like personal finance, like actually what you would spend on a given month might have been like not fully fleshed out, because like you said, you're still living with your parents. Maybe you weren't buying all the things. And so after having that conversation, you get married, that starts becoming your responsibility. I'm curious, like, how things change, because a lot of people, when they get into personal finance or an idea of early retirement, they get almost like obsessed with it, and they go almost too far, and they start like watching every penny, and they start maybe shrinking things too much. Just kind of curious, like, what your reaction was to pulling that veil back and seeing behind the curtain.
I had a transition. So in the beginning, I used Quicken, and for Quicken, I actually had I forget what it's called, but basically every category I was tracking. Like my wife and I literally set budget for every category, for how much we spend on food, clothes, etc., different things. And we watched that we are not overspending for each category. And I was like, I think once I did download QuickBooks, Quicken download every day, for a long period of time. And then over time, and when we get married, our income was a lot less, and we had to be a lot more frugal, this kind of things. Over time, I modified this, kind of made it looser, because I'm not as constrained as I used to be. And now I basically have very loose spending in 4 categories. Experiences, like travel, like vacation, etc. We have very loose budget. Time, I'm willing to pay to buy time. Meaning, the simple example would be when somebody needs to mow your lawn, you can do this, or you can hire somebody else. Okay, but I have an assistant who does scheduling of all my calls, as an example, and so on. So I'm willing to pay money to buy time, because. And today, I can afford to do that. Okay. And number 3, health to me, basically that category, like I have a personal trainer that I work out with twice a week. And the last category is education. My kids basically don't have a budget on how much they spend on books, as an example, or etc. So, but this is important. I have these 4 categories. They rank very high on they're very meaningful to me. And when I spend money there, the money buys me the most, because I get the most value out of them. Now, at the same time, for a long time, until recently, my wife drove the same car for 12 years. I apologize. I think we're going through a little hurricane here, but my wife was driving the same car for 12 years. I drove the same car for 10 years. We live in the same house I bought in 2004 for 18 years. So yes, so we have categories where we basically have very loose spending, but at the same time, we realize that the house we live in, it's not as important to us. Cars we drive, not as important to us. So that's how it kind of evolved over time. But I would argue that the first 15 years of our marriage, or maybe 10 or 15 years of our marriage, us kind of having a budget kind of created this muscle that we are very responsible with our money.
Something that while you're talking the whole time, I couldn't help but think about, because you wrote about this in your book, is kind of thinking of your expenses in terms of time. And it was interesting, like this whole podcast, I don't think you've used a dollar figure. You were like, that's going to cost 400 hours, or that's going to cost you 5,000 hours of work. When did that kind of whole mental shift happen?
When I realized that as you get older, Cody, Justin, as you get older, you realize this is not forever, and you realize that you only have so many weeks left on this earth, and therefore I'm willing to, like at some point in time, I went through the list of things I did. I do, like, I mean, at work. And I realized these are the things where I had the most value. And this is the things that are only I can do. Okay. Everything. And then the other things could be done by somebody else. And also, I like doing these things. I add the most value. These things, I don't care about doing this, and anybody else can do this. And the other bucket, I give it to somebody else to do. And now I spend most of my day doing things I love. And this is how I receive the most satisfaction. I'm doing things that are meaningful to me and things I enjoy. Okay. I'm still working long hours, but it's so much easier to work when you do things you love. And by the way, also think about this. I could have spent, to schedule this podcast, there was probably emails going back and forth between my assistant and your team. All right. That's in every single time, so every mail takes maybe a few minutes. And so let's say it took 20 minutes to schedule this podcast. It took another 10 minutes to schedule another appointment I have. During the week, it adds up to 3 or 4 hours, right? I could have spent my time doing this. And over a year, that's a lot of hours. Or I could have been doing this on writing. Or I could have been doing, even more importantly, spending time with my kids. And as you look at, I look at my kids and I realize, especially the ones that still live at home, I realize I only have limited time left with them, because like my 20-year-old son now is out of the house, so I see him a few times a week. We talk on the phone all the time, but I still see him only maybe a few times a week. Where my daughter's still at home, and that's a very finite time I have with them. So I can spend this time on scheduling, phone calls, appointments, or I can spend this extra hour spending with my daughters playing chess or whatever. And that's, so I value my time tremendously.
And that kind of makes me think about, the new book, the Soul in the Game, and thinking about like leading a meaningful life. Like, it obviously seems like something very important to you and something you're passionate about. But how did you decide like you wanted to kind of tackle a subject matter like that with somebody who is maybe known more for just a financial background and having that financial pedigree? What made you want to take and write a book about such a subject?
So I started writing in 2004. And by the way, I'm going to answer your question, but I'm going to take a small detour. Writing is probably one of the most important things that has happened to me in my life. Like as an individual, I'm not talking about, it's in the same level as having kids. Okay. Because I write about 2 hours a day, every single day. Like I wake up in the morning and I write. And that made me, it's basically writing forces you to, to have a focused thinking about a subject line, about a subject. And when I started writing, I only, in the beginning, I only wrote about investing because I had, that's my day job, that's my education, etc. So I kind of had the right, to write about that. Over time, I And so I have a newsletter, and it's absolutely free, and I have a very large subscriber base. And so when I would write an article for Financial Times or Barron's, people would subscribe, and so they don't have to go to Barron's to read it. They can get the article emailed to them. And little by little, I started to add some personal notes about my kids, observations I made about my kids, or a trip to Santa Fe, or whatever. And I also love classical music. So I started to add musical notes at the bottom of the article. And over time, the non-investing section kind of grew in size. And nice thing about having a reader's email list, you get, and you guys are aware of this now, you get feedback. And the feedback actually is important and then people say, Vitaliy, I came to you for your investment articles, but I'm actually staying for your life stories. As a writer, hearing that is very important because that gives you confidence. Because writing about investing is easy because I have a pedigree to do this. Writing about life, I didn't go to life university. I'm just like another person, just another guy. And that gave me confidence to write more and more about life. And over the years, I had basically a lot of articles written on this subject. And my readers would reach out to me and say, you should really put them into a book. And that's how the idea was born originally, from my readers.
This is kind of taking a left turn, but I kind of want to talk about going back to the very beginning here where, you came to America and there's just like an unlimited supply of Coke and Pepsi. And you talked about how, if you're chugging 7 Cokes a day, it's not that enjoyable after, a couple of weeks of that.
Yeah.
How do you, on a tactical level, build scarcity into life just so that you can enjoy things more? Because you could go out to eat every night of the week at a restaurant, but then after a while, you're gonna be like, I'm sick of eating at restaurants. This isn't special anymore. I'm hoping for our listeners out there who, maybe they are going to Starbucks every day and it's not on their value list. How do you start to build some of that scarcity in your life so you actually, enjoy more things and truly build a meaningful life for yourself?
All right. So you brought it up because I have 2 stories.
Okay.
All right. Okay. So let me talk to you a little bit more about my diet. Okay. Because that's okay. So I found that for me, when I'm in Denver, I basically don't eat bread. I don't eat steak, like red meat. And so I don't eat pasta. So I don't eat carbs, red meat, and I don't eat sugar, like no sugar at all. Okay. So because I look at my diet in Denver as basically all I'm trying to do is to put the best fuel I can into my body. Again, that's the diet that's appropriate for me. So lesson number 1 here, especially about sugar. One day I told myself, I don't need sugar. I don't need desserts. So when I say this, it's not like that sometimes I eat cookies or sometimes I eat cake. No. When I'm in Denver, I don't need it. So now it becomes what I call a half binary decision. It means it's not yes or no. It's just no. Here's important to understand. When you make a decision half binary, it consumes 0 energy whenever to make it. Because when somebody offers me, I'll give an example. I go to my mother-in-law's house and they make shish kebab. And she offers me steak, and I don't eat red meat. And she says, God, this meat is so good. You should just eat it today, just today. I said, you don't understand. If I eat it once, next time I have to make a decision. Next time I have to make a decision, that consumes willpower. I have very little willpower. So that means I'm going to start eating all the time. So this half binary decisions, and by the way, we make them all the time. I have a friend who is a very Orthodox rabbi, and he was at my house and he was telling me, Vitaliy, I eat too much bread, and I said, well, just become a person who doesn't eat bread. He's like, well, no, that's a very difficult thing to do. I said, well, do you eat pork? I said, no, I don't eat pork. I'm like, does it consume if I offer you pork right now, how much energy is it going to consume? He's like, 0 energy because I'm the person who doesn't eat pork. I'm like, just become a person who doesn't eat bread. The true story, the guy lost 20 pounds or something, 3 months later. Just he became a person who doesn't need this. Now, there's a second part to the story about scarcity. Now, and this is what I call my 8% diet. Okay. So I figured out that I travel about about a month out of a year. Like when I say travel, some went for business, a lot of it just for pleasure, whatever. So I spend about 8% of my time outside of Denver. When I'm outside of Denver, I have no diet. I eat as much pasta as I want, as much steak as I want. And I tell you, I enjoy that ice cream so much more when I travel. And you may argue that because I started traveling more than I did in the past, and maybe there's some truth to that, but it's not like I don't have a 16% diet. It's still maybe it's 9 or 10. But the point is, because I kind of manufacture the scarcity, I actually enjoy eating, steak and sweets and, and pasta, etc., and bread so much more when I travel. And also another thing is important to realize: when we do something more than once, we create a habit. So, and this is and we should be mindful about this, meaning that when you go to Starbucks for the second or third time, you should ask yourself, am I creating a new habit? And then you should ask yourself, do I want to have this habit? I'll give you an example. We have a cereal bar at my office. So they have oatmeal and you have a lot of dried fruit. And we have dried strawberries. And I caught myself that over 2 weeks, I went through a few pounds of dried strawberries. Okay. And which has just violated the part of me not having sugar. That's, because I didn't even realize that dried strawberries have a lot of sugar. But anyway, and then I realized that there was a time, like when I had it for the second or third time, I created a bad habit. And so I stopped doing this. And now, when I have oatmeal, I just put some raisins. And so whenever I do something, and I do it more than once, I kind of ask myself, am I creating a bad habit? Or good habit?
That actually makes me think about when you talk about a half binary decision. We talk a lot about with personal investors investing their own money, trying to take the emotion out of it. Like when the market is down, like not making a knee jerk decision and just selling. I'm just curious, like maybe your thoughts on it. If it comes up at all, I don't know if it comes up at all in the book, but like how are some parallels there that maybe people could take into their investing journey to where some rules they can set up towards says like, hey, this is what we do no matter what. Like, no, there's no decision to be made. It's not like, well, yeah, but this time is different. This time the market's definitely crashing in 6 months. I need to get my money out. Like how to instill some of that half binary logic into your
this requires
journey.
like another episode of this is a 30-minute conversation. This is in fact my little book of sideways markets would be a perfect book for that, actually. Okay. God, there's so many ways to answer it. Number one, you can't time the market. You really can't. So, if you analyze individual stocks, I'm trying to figure out how to pack this in the. All right. Let me give it a try. So I think to be a good investor in the long term, you have to be process based. Okay. So you really should focus not just the outcomes of your decisions, because especially in the short run, because I can do the best research possible. I can find $1 that's trading for 40 cents, and the market can still take the 40 cents to 30 cents. In the short, it makes because it was irrational. Think about it. For $1 to be traded at 40 cents, that's irrational. Why can't it get even more rational to get 30 cents or 20 cents, right? So this is why having a long-term time horizon is very important. That's number one. So don't let the market shrink your time horizon. That's point number one. Point number two, you have to be in a circle of competence. In other words, if you are if I were to start analyzing biotechnology companies that have one drug, I would not be a rational investor. And the reason for that, because I never did good in biology, and I would really have no idea what's going on. Okay, because it's so far outside of my core competence. Okay, I found that I do the best when I analyze companies that have significant competitive advantage, whose products I understand, who have significant cash flows, who have good balance sheets, good management. So now I'm on my core competence. Okay, so therefore this is important. As an investor, you want to manage your EQ, which is your emotional intelligence, and your IQ, which is your understanding, kind of, into your intellectual quadrant. So here's the thing: if you are go very far away from your core competence, your EQ is going to be very low. Okay, and here's the thing: the lower your EQ, the lower your total IQ, because you can become a lot more irrational when your EQ is low. I would argue EQ is more important in investing than your IQ. You just need to have like average IQ and above average EQ. Okay, so when I just wrote this article where I talk about how in investing you have to be thoughtfully arrogant. What does it mean, thoughtfully arrogant? Well, buying or selling, like when I buy a stock or selling a stock, that is an arrogant decision. Why is it arrogant? Because somebody's selling you the stock. When you go in the stock market, you want to buy shares of IBM, somebody is actually selling you the shares. So they have the reasons to sell. Some of those reasons have absolutely nothing to do with IBM's business and have to be driven by person's personal stuff. Okay, but a lot of it has to do with what person thinks about the business. So when you buy an IBM, you're basically saying, I know more, or I'm right, and the person who is selling to me is wrong. That is arrogant. That there is some arrogance to that. Now, you can have arrogant arrogance and you have thoughtful arrogance. Arrogant is because you're basically saying, because I had success in the past, and because I'm buying it, is going to work. Okay, so when your successes when you make a decision solely because of who you are and your past successes, most likely at some point you're going to pay a dear price for that. And as an example, Masayoshi Son, who runs SoftBank, which is a huge company, they just took a $20 billion loss on the investments. And Masayoshi Son himself admitted that he was arrogant. He got completely infatuated with his previous successes. Now, what we practice is thoughtful arrogance. Okay, what is thoughtful arrogance? We've done a tremendous amount of research. We do tremendous amount of research on every company we buy. And that gives us an opinion that we think this company is worth $1 and we buy it for 50 cents. And now, we have an amnesia about our past successes or past failures. All we focus is at how much this company is worth based on our research. And then the arrogance comes where we come in and say, we're going to buy it. And especially as a value investor, a lot of times you're buying things that everybody hates. And the arrogance comes is that you actually follow your research and go have your decision. Now, and then, after you bought the stock, this is just the beginning of the journey. Okay, because then you can have good news come out, bad news come out, and you have to make adjustments you're going to have new information. And sometimes you have to change your mind and you say, these were my assumptions. New information came in. I changed my assumptions. Now this company, which I thought was worth $1, is worth 60 cents. Good thing I bought it for 40 cents. Therefore, there is, maybe it's not a good investment anymore, but, I'm not going to lose money at least. Anyway, or, and so on. Or sometimes you are going to lose money. And again, that's part of investments. That's just part of life.
Yeah. All part of the long game. Well, Vitaliy, just in the interest of time, I think we'll wrap it up for today, and maybe we'll have to have you on for part 2 because, like you were talking about, you've just been taking these questions in stride, and we could have probably 30-minute segments on each of these questions. For those in our audience, though, who want to keep up with you, I know you have 2 previous books on investing. Now you have your most recent book launched in June, Soul in the Game. Where are the best places for people to connect, get your books, all that good stuff?
All right. So if you like to listen to podcasts, we have a podcast. It's investor.fm, or just look for Intellectual Investor. And it's basically just my articles read to you, like articles on tape. Okay. So that's number one. Invest, or if you want to subscribe to my newsletter, and again, it's absolutely free, and just you get my articles, get classical music, my life stories, investments, Contrarian Edge, EDGE.com, contrarianedge.com. Now, if you bought the book, and I think Eve is the wrong. Yeah, when you buy the book, go to soulinthegame.net, and actually I wrote 5 new chapters after the book already went to print, and I'm going to keep writing more. So you're going to get instructions how to get new chapters I've written. So that's soulinthegame.net. That's where you can get information. And if you're interested in value investing, which I think this is, you can just get a free chapter, that free primer on value investing on 6commandments.com.